Going on, everybody? It's your boy JT, and we are back to the Crypto Den. I want to thank you all for tuning in. Today, we're going to talk about how to optimize your returns in a bull market, which I think is an important topic, but it's not financial advice. This is just my opinion and an insight into the decisions I make at the hedge fund for my capital partners to look at and for you all to observe and either call me an idiot or, um, appreciate what I'm doing. So, with that, before I get into it, if it wasn't clear, I run a hedge fund. We are a crypto hedge fund called Bleeding Edge Capital. We are a research-driven fund, and we are discretionarily long. I leverage my over decade of software experience to underwrite this entire market, protocols, networks, developer activity, all this other stuff to create a unique proprietary buy box that I then, deploy investor capital into at reasonable prices. And you could consider it like a value shop. You could think of Warren Buffett if he was into tech, even though he's historically a laggard. Dumps on Apple 15 years, buys it after it hits 150 billion and, rides it up to a couple trillion, but he is a laggard nonetheless, right? So I just follow the very first rule, which is invest in what you know. And my entire career has been software, right? I have a finance degree, but my background is all software. I've trained myself. I've had a software development company. I've had multiple startups, and software is just my gift. So I went all in on crypto years ago, and it's been one of the best decisions I've ever made. So the way I handle market cycles is essentially, you know what? I'm actually going to pull up a chart here. Hold on, y'all. Let's take a look at Kraken because I am a big fan of Kraken. Let's get this chart just a wee bit better. So if we go back, this is just Bitcoin USD. This is the monthly chart. So these are bigger time frames. Each candle is 1 month, and the volume could be hundreds of billions, possibly, I don't know, trillions. That'd be crazy, but at max, a couple hundred billion per candle of volume. And I like that because it's more data. Now, when I go and look at these market cycles, right? Up, sideways, up, boom. You can see that the bottom of all of these is higher than the previous bottom. There's that bottom, that bottom, that bottom, right? So, I mean, realistically, Bitcoin, even with its volatility, is up only. So, what I like to do is I like to rotate profit into cash, and then I wait for this volatility. So, let's say I were to buy Bitcoin, and this, I'll go through me personally. I was buying, now this wasn't the hedge fund, be clear. I opened the hedge fund sometime in 2023. It takes way longer to open a hedge fund than you would than you could imagine. I was personally starting to buy when Bitcoin broke below 20,000. So whenever I woke up and it was below 20,000, I was buying. Now you may ask, why was I buying there? Well, the cost to produce a Bitcoin was right around 23,000. And I'm sorry, 46,000, the halving and all that. I apologize. The halving happened sometime in 2020. So when it's trading below the cost of production, now let's see this. Uh, what does it cost to make a Bitcoin? Um, in Bitcoin, right now, the average $89,000. This is the current price. So in the bear markets, we can see a drawdown of up to 60% below the cost to produce, meaning you are up 60% from a miner if it goes down to 30K, which is a reasonable range for Bitcoin. We've seen it drop within 20 to 60% below production per bear market. Because if you get the same unit of Bitcoin, I'm sorry, if you get the same amount of money goes into an operation and your output is cut in half, that also means your production costs double, right? You have to literally spend twice as much to get the same amount. So the cost of Bitcoin's always going up with the halving, and also the amount of Bitcoin you get is cut in half. So in general, mining over time gets compressed, and you have bear markets where the token will trade at a deficit to what it is being made for. When I see it go below 20, 30, 40% below production, I'm buying. So I dollar cost average. I sniped the bottom because I started buying at 20, right? On literally every day, I would put $1,000, $2,000 it was below 20K. And I would then start rotating into alts when it broke 35, about 10%. That made me think that the bear market was likely over. Okay. Now we're sitting at 90 something. I'm up 400%. I have already pulled profit, right, at 90,000. I thought that was crazy. I put it in cash and I wait. I simply wait. And then I buy more things that I think are going to do well. So I bought Celestia. I rotated into more speculative, higher risk things to optimize my returns. Once they break a few 100%, I take my cash. I let the bank or the house really, right? So I pull my principal plus a return and I let the house do its thing. And I'm good with cash because cash is how you can hedge against the volatility in a long strategy, right? I mean, if we go to Warren Buffett, he is long, he's research driven, and he's sitting on 30 something percent of cash right now because he had 600 something percent returns in Apple over 6 or 7 years. That's just being a good fiduciary. Okay. The market is going to give you amazing opportunities. If I go to the week, hey everybody, it's JT. Just in case you didn't know, I would love a sub. Almost 97% of you that have viewed our content have not subscribed, and it would mean the world to me if you just hit that sub button, give us a like, and let us know how we're doing. All right, back to the content. We went from 95 down to 78, and now we're back up to, right around 95. If you would have just put a little bit of money in there, you could have made 20% on that dip, and you were getting it at a discount, right? So there's two conflicting ideas. Some people like to never sell and just accumulate when it gets cheaper. And that could also be a strategy. I know Raoul Paul, who is a way more veteran fund manager. He's a macro analyst, been doing this a long time. He himself does that, where he basically did a retrospective analysis on his portfolio and realized that, oh, wow, if I would have just kept adding the positions, I would have made more money. And that's looking after the fact. Like, he got some of those things right that he had no idea could have panned out or not. Um, so it's really more about preference. How active do you want to be in your personal portfolio in general? And as a fund manager, it's a little different because you have capital coming in throughout the bull market. So it's a little bit different of a game. You're always going to be getting liquidity, and you have to figure out the best way to handle that. For a personal portfolio, generally, if you're buying the right stuff, you may never see the prices that you saw in a bear market again. Buying Chainlink at $4, buying Solana at $9, right? Like crazy. So we may never see those token prices again. We may not. And selling them at a massive profit feels good, but it creates tax burdens, and you very well may never be able to get that token that cheap again. So your entry is going to go up. So if you bought it at 9 and then you buy it at 50, your entry, depending on how much money you put in both instances, could go up from $9 to 30, 40, even $50. Not really 50, it averages it, but you get the idea. If you're going long, and your average entry is $35 versus $10 and it tops out at 300, that's a difference of a 10 and 30x. So your entry is really, really, really important. And that's why I like to have cash because the market, if you listen to Benjamin Graham or Warren Buffett, right? He's your partner. The market is your partner, and he is a psychotic drunk. He's going to do unreasonable things all the time, and you have to learn how to work with him instead of fighting him. And cash allows you to take advantage of his, idiosyncratic, rages when he has a fifth of jack. So, uh, that's personally how I like to do it. My fund right now is 1-to-1 cash Bitcoin with the rest being alts, and that is about a 60-40 split. So I'm very risk off. This is the tail end of the bull market, in my opinion. I think we're going to have great prices in the next 12 months. Um, and actually, I'm going to stop it there. Make sure you like and sub because the next video, I'm going to talk about basically why I believe there's going to be better opportunities to buy crypto in the next 12 months. I think that could be a really cool thought experiment. I think about it a lot. It's top of mind, and I believe my opinions could help you guys make better decisions. So until next time, take care of one another, and I'll catch you back in the crypto den next week. Cheers.